Hey, welcome back. This is Matt, the Helpful Home Inspector, coming at you live from our studio up in Hartford, Wisconsin. We got a great show for today. We're going to be talking about all kinds of interesting things to help you better maintain and take care of your home, and today, improve your life a little bit. I have my good friend Bill Moeller here from Bank 59 or Bank High Five. Oh, we missed it. There we go.
Edit that out.
Yeah, we'll edit that one out, Tammy. But if you want a high five, stop in and say hi to Billy. He'd be happy to talk to you about your mortgage and lending and all kinds of fun bank stuff. He's kind of a bank geek when it comes to that. Self-admitted. I'm assuming. Yeah.
Mortgage nerd.
Mortgage nerd. Hey, nothing wrong with that, man. That's what the guy you want to hire. But we got lots of good stuff for today. Today, our main topic is going to be talking about HELOCs. If you don't know what that is, we're going to explain that in a little bit. And we're going to talk about cash-out refis. Both ways that you can get money you probably didn't know you have. So we can get into that a little bit later to help you with that remodeling project, the buying a new car, putting your kid through college, whatever that may be. We're going to get into that a little bit later. But we're going to start off the show, as we do always, with our defect of the week. So the defect of the week was something that I addressed up north, and when I got up north or whatever, I got in the shower, and the shower started filling up with a little bit of water.
Ruh-roh
is right. And our the house up north doesn't have the best of drain systems. Basically, they ran 1.5-inch drain everywhere instead of 3.5 or 4-inch drain. So it's whatever. That's a whole issue that it's a crawl space, and I don't want to get in there. And so
it sounds like a hot mess to change.
Yeah. I'm kind of pushing that one down the road a little bit. But when the water starts filling up or whatever, that basically means we have a slow drain, and we need to clean it out. And usually we keep a little screen on there to catch Tammy's long hair. No offense to Tammy. Tammy's doing her thing, and I like her long hair, so I'm not complaining about that at all. But when I pull the little screen off and get the little bit of hair out of there, that didn't do it. Uh-oh. Now it's deeper. So I go get my little drain weasel. Not that I own any stock in drain weasel, but it's a great little product. If you've ever,
it's not a paid product placement.
It is not a paid product placement, but it works. It does a really good job. So I send this down into the drain, pull it up, whatever, and I call Tammy. Tammy, come in here and bring some paper towel. And it was just this nasty hair clog of you're sitting there, you
just had a visual of a petri dish for it.
Yeah. I mean, you're just gagging at this because it's like soap and stuff and grime.
Well, if you clean out the trap in your sink in the bathroom, you could get a similar result.
Yep. Same type of thing. So you get these hair clogs, and they can be kind of gross, kind of disgusting. So get a drain weasel. I think we picked these up at Menards for like $5, and it comes with 2 reusable things. You just can clean off. This is like a Velcro thing down here, and it's even got a little wonder wheel on here that you put it on there. You can twist it around or whatever, and the hair gathers all around this and pulls it out. Works like a champ, okay? And it's not going to damage your drain. If you're putting chemicals down your drain and stuff like that, you could damage your drain. You want to avoid those chemical products, Drano and things like that. They have their purpose, but for everyday drain clogs and things like that, a mechanical removal is really the best way to go. So actually, we can leave that out there as a reminder. Drain weasel, clean out those drains with mechanical drains is really the way to go. They do make zip sticks and things that they have like these prongs that come out of them, and they work, but they get stuck on the drain a lot, and you can actually, with those drains, they're made out of a really cheap pot metal, so you can pull that up and rip that thing apart and damage your drain stop. And if it's damaged, then you can't get it out to replace it if you need to. So I'd kind of try to avoid those things. The drain weasel is going to work a lot better for you. All right. So that is our defect of the week. The next thing we have, save a buck. And we're not always about construction. Today we're talking cars. Okay. So one of the misleading things that people have that they've carried over since the 70s is that you need to get an oil change every 3,000 miles.
Absolutely. And they intentionally put the sticker in the window implying that you need to do that.
Implying that you need to do that. Even though your car today should not get an oil change every 3,000 miles. Every 5,000 miles is completely reasonable. When they pull that oil out at 3,000 miles, ask them to take a look at it, and then take a look at the new oil. It doesn't look a lot different.
Yep.
Our cars today are manufactured in such a way that they're not having the excess wear and tear and heat and things like that you experienced in older vehicles. And so,
absolutely.
And the oil products are better. You're using synthetics or partial synthetics and things like that. They're going to make the engine oil last longer and not break down as quickly, and so the oil does not need to be changed every 3,000 miles. So if you can push that out to 5,000 miles now in 2 oil changes, 10,000 miles, you're saving one whole oil change. So an oil change these days, what, $70-$80 by the time you're done?
If you don't get the upcharges at the Quickie Lube.
Yeah. If you don't let the Quickie Lube guy change your air filter out, and I don't know.
They wanted less. I went in and got my daughter's oil changed at the Quick Lube by the house, and the guy quoted me $45 for an air filter. What? And then he proceeded to ask me what I'd be willing to pay.
Oh my gosh.
And then by asking me that, it resulted in us not going with the air filter.
Yeah, just stop by O'Reilly's and pick one up for $8.
Yeah,
okay,
pretty much.
And it's that simple. And it's you have 2 air filters you would change. You would change your cabin air filter, which is usually behind your glove box, and then you're going to change your overall air intake filter, which is going to be up in your engine compartment. Usually just one little hood that you had to pull off or whatever and to swap it out. Pretty easy to do. And $45 versus $8. That's huge. I mean, we talk about margins. That's like
he was trying me out.
Oh, he was trying. Yeah, I guess, man. And you're the dad. You want to you're doing right by your daughter's car and everything, But definitely oil changes every 5,000 miles, not 3,000 miles, no matter what it says on the sticker. Okay. Rip that sticker off. It does. I mean, unless it's got a coupon on it, then you can save it, I guess. But otherwise, throw that away and go with every 5,000 miles. You're going to be better off. You're going to save not only $1, you're going to save lots of bucks. Okay. So that is our save a buck for the week. Co-host question of the week. And Bill, this is his first time solo co-hosting.
Yep.
So welcome. Glad you're
here.
Thank you. But we just recently had Father's Day weekend.
Absolutely.
I had a great weekend up north. What was the best part of your Father's Day weekend, man?
Well, Cub Cadet tractor, a new zero-turn tractor, got delivered to the house on Saturday.
Nice.
And I was really happy with the result.
Those zero turns are nice. Yeah. And Cub Cadet, they have a striping thing automatically put in it, kind of, don't they? Not like Simplicity, but
I bought a striping kit for it.
You did. Okay.
It's like an extra $100, but this particular tractor has a steering wheel on the front instead of the levers.
Really?
Yeah, at my wife's request, we got that. It was only $1,000 more. It wasn't bad.
Really? And that's nice. Instead of the levers,
it was awesome.
Every zero turn I've ever had, you had the levers.
So think about when you pull the lever one way or the other, it's gonna reverse or forward the wheel on the back wheels. Well, in this case here, the front wheels will turn. So you can literally still make a full 180-degree turn, but you're just turning the steering wheel.
Oh, okay.
And it's
not
awesome.
actually using the power of the wheels to turn.
Yep, which rips up your grass.
Yeah, and because when we had our Skag and stuff like that, the front wheels are just casters, you know, and the turning actually happens with the power wheels turning one way or
exactly.
the other. So in this case, you're actually steering the front wheels, which are not casters, they're actually steering wheels.
Yep.
And because of as long as you can get enough turn on it, you can still get that full 100.
The radius was great. I know Consumer Reports didn't give that particular tractor the best rating. It was like a 75, but
that they give Cub Cadet a little bit of a discount all the time. It just feels like but Cub Cadet, they last just as long as any other mower.
Yeah, well, my last one lasted 16 years and would have lasted longer had I maintained it better.
Yeah. Well, that's a lot. You got Russ Benzer from the Mobile Repair Guys.
And Russ was at my house 2 years ago.
There you go.
So Mobile Repair Guys.
Yeah, Mobile Repair Guys. Russ Benzer, great guy. If you're looking for a franchise or want a job, give him a call. He's really swamped.
Yeah, he's a great guy.
Dude's working till 9 o'clock at night some nights. I'm like, dude, that's Russ. You got to shut it. He's like, I got to build this. I'm like, man, you're too close to retirement to worry about building an empire.
I met him when he started. I can totally see how passionate he is.
Yeah. He knows a ton, man. Just a wealth of information. So, and then at my best thing, we were up north and we got to go golfing. So I took my son and my wife and my son's girlfriend. We went out there and we did a little scramble. And they followed Rule 19 of Father's Day weekend, is that Dad wins all the time. So Dad won.
To keep score over a 8 or a snowman?
Well, I don't think we ever got over. We did a scramble, so it was basically.
So you didn't have to go up that high.
So we never got that high.
That's good.
Yeah, which is good. So when everybody hit their balls in the woods or water or whatever,
someone else had
a shot, and then I got to go get some bubblegum ice cream, which was the prize for winning, right, babe?
It was
good stuff.
It was awesome.
I mean, it wasn't a fancy course or anything. I don't need a fancy course.
Yeah.
I just the company and the time to do it,
Absolutely.
and stuff like that. And it was a beautiful day. I mean, it was 74 degrees and sunny.
Perfect.
Can't beat it, Yeah. So that is Father's Day weekend. Now we're going to get into our main topic here, and the main topic is financial in nature. Okay, and when we're talking about the main topic today with HELOCs and cash out refis, we're talking about managing the equity that you have in your home. a little bit differently than what you may traditionally be used to. Okay. And for anybody that is new to owning a home or anything like that, you probably don't even know that these things are available to you. Okay.
A lot of people don't really even think them as primary alternatives for ways to manage your debt.
Mm-hmm. Yeah. Yeah. And it is, whether you want to consider it hard money or soft money, whatever it may be, it is your money. It's just tied up in your home at that point. Okay. And this is just a way for you to pull some of that money out of your home and use it for other purposes, and by other purposes, it could be whatever you want. Lots of times people think, if I do that, I have to be something with my home. Not true. You can pay off credit card debt. You can buy a new car. You can put your kid through college. It's your money.
Absolutely.
And nobody's there governing your money when it comes to those elements. Now, if this was a construction loan, that's a different story. If this was a
because then they want to know what you're doing with the money.
Exactly, they want to know what you're doing with the money and where, and that money is being put towards the investment that they were planning on, and then it has the value at the end of it. And,
but based on what you were looking to appraise it on with those improvements.
Yep. Or if you had money in escrow that was put in through a real estate transaction, anything like that. Those are things where you have to spend it on certain things that are set aside and determined ahead of time,
100%.
These things are not. This is basically just taking money out of the bank, but your bank is your house, and it's, these are just two different ways, which there's a couple of other ways too, that you could get some of that money out. Right. But these are probably the two most common ways people will get some of that financing out of their home. So I guess the first thing to understand is that there is increasing levels of debt that people are carrying these days on credit cards and car loans, and
exceeding pre-pandemic levels.
Yeah. And going unchecked in a lot of cases, and because the numbers aren't as astonishing to us anymore because of inflation and other elements of the reality of what we're going through right now. Okay. But it's not okay. We need to kind of look at that a little bit differently.
Heart to heart.
Yeah. Have those hard conversations with your spouse and significant other, as to, hey, our credit cards are at 24% interest, whatever it may be.
Bank rate says they're in the low 20s. For you to get a credit card interest rate that's in the low to mid teens, you'd have to have 740, 760 credit score and very low credit utilization. They actually have a really quick and easy way for them to look and see what your credit utilization ratio is when you're on a call with them, and they're going to quote you an interest rate if you're trying to negotiate that.
Sure.
Because people years ago used to call the credit card companies and I'd say, hey, Matt, would you mind? I want to renegotiate my interest rate. I have a really good credit score. And people would just bounce from card to card to get those 0% promotional rates.
Yeah. Yep. And that was a common thing. Right.
Yep.
And today that's not happening as often,
Right.
and because the interest rates and the offers from the credit cards aren't what they used to be.
Right.
So when you're looking at the interest rate of 20%, we'll say, okay.
Mm-hmm.
And comparably, you're looking at the, what we'll get into a little bit later with prime rate and what the rates might be for some of these, equity products and things like that. You're cutting it in half or better than half.
Absolutely better than half.
Yeah. And in a lot of cases, you're saving thousands of dollars a year in interest rates. If you're carrying $20,000, $30,000 in credit card debt, that's a big number.
The average person who has credit card debt carries between $5,000 and $7,500 in credit card debt.
Yeah.
Just carry ongoing.
Yep. Yeah. So these are ways that you can get some of that money out of your home and pay down some of your credit card debt, pay off some other high interest rate products that you have. And we're going to get into kind of looking at your situation.
Yep.
And there's some tools that Bill's brought to us today that will help you kind of look at your situation and figure out what might be the best route for you to go in managing that money that you have built up in the equity of your home.
You need someone to be a debt manager that's going to help you map it out.
Yeah.
The idea that it was your best thinking that got you to this point. But the reality is that if you aren't using the tools effectively, the longer you wait to address it, the harder it might be to get out from under it.
Yeah. And it's going to cost you more in the meantime.
Yep.
Too. Yeah. So one of the things that we want to talk to you guys about is debt to income ratios are stressed, and we need to do something about that. And the way that we can do that is by managing our debt that we are carrying a little bit differently. And so when you talk about debt, there's this thing called interest rates. Okay. And interest rates, we've been kind of bouncing around a little bit, but interest rates are determined by the Federal Reserve Bank in Washington, D.C. And then they vary based on what the product is that's being lend or whatever, right?
Yeah, so the discount rate is basically the main tool that the Federal Reserve uses to stave off inflation. They raised interest rates 10 times in the last year. Mm-hmm. So they basically took us up in quarter point increments, they call it 25 basis point increments, and June was the first month that they were having a meeting that they actually paused.
Yeah. And when we talk about the Federal Reserve, it's a group of people that are managing the Federal Reserve Bank, which determines the interest rates.
And they're all called Fed presidents.
Fed presidents.
Yes.
I thought they were governors.
Yeah, they're presidents.
They're presidents now.
Yeah.
Oh, okay. Well,
yeah.
They are appointed, generally speaking.
Yep.
And some of them have been on the Federal Reserve Board. It's not like a presidency thing. Like the president can appoint a number of them, I believe, right?
Yes, true.
But like President Trump appointed a number of them, and the guy that's actually in charge of it, which
Jay
we're not going to... Whoa. Hopefully you don't hit rewind and find out what the question giveaway is today. But yeah, so the guy that's in charge of the Federal Reserve was actually...
We got a while to talk, yeah.
We do it. They'll forget all about it. But he was appointed under... was it Trump or Obama? It was one or the other, and then he was carried through in Trump, and now I think it was
Obama.
Yeah, and then it was Obama. Then he was Trump kept him in, and then Biden's keeping him in just because he's doing a good job.
Yeah, because before him there was Janet Yellen.
Yeah.
Before her there was Ben Bernanke.
Yeah, Ben Bernanke was kind of a little more controversial than the current people in the charge of that. But they're a group of very smart people. Don't get me wrong.
Yeah.
And they basically have a job of balancing inflation, interest rates, the U.S. economy, essentially.
It's basically the debt service on the national debt too.
Yeah. And all of the banks, all of the credit cards, all of the car loans, all of that
has a direct correlation.
Funnels back to these guys. And that's where prime rate comes in, correct?
Yep. So for those of you keeping score at home, the prime rate is 3% over the discount rate. So when they say that the discount rate, when you hear that the Fed raised the discount rate by a quarter point, that means that if they go, like, let's say in July, right now, there's a futures index for how likely it is that they're going to raise the prime or the discount rate. Mm-hmm. Right now, there's a 60% likelihood that they are going to raise the discount rate another quarter point in July. But they did, however, qualify it by saying that it's data dependent whether or not they're going to do it.
Yeah, and these are predictions that the talking heads put out. They're not the Federal Reserve coming out and saying there's a 60% chance, correct?
No, it's basically a separate entity that has kind of like the weather a little bit.
Yeah,
they have a way to gauge it.
Yep.
With all the forces that are at work right now, and the markets do react to it.
Yeah, the markets definitely do, and so that's why these people have to be very careful about what they say and do.
Keep the cards close to the vest.
Yeah, because if they say the wrong thing, it can throw the stock market into a tizzy and could cause people to freak out and do all kinds of crazy things. But a lot of times, as far as your average American, we just need to relax, and things are going to level out. Yeah,
zoom out,
and lots of these changes that happen in the stock market are knee-jerk reactions to what's being said or done. Interest rates being raised or lowered. It's really not that important to us as individuals.
Day to day.
Yeah, as individuals, day to day, running our lives, doing our thing. But if you have $1 million invested in the stock market, you might have a little more interest,
Yeah.
If you have $500 million invested in the stock market, well, then it's a big deal,
Absolutely.
But if for your average day-to-day person or whatever that's just riding the stock market out, it's nothing to freak out about, nothing to jump out of the stock market because they're going to raise rates by 0.25%. It's just that's not realistic, But when it comes to prime rate and understanding that interest rates can affect your car loan, your
borrowing costs,
your home loan, all that kind of stuff, it plays a role. Okay, not as big of a role as you might think, but it does play a role. So if the prime rate goes up by 0.25%, what happens to the discount rate?
The discount rate went up by a quarter point prime rate. So, for example, if right now we're at 8.25% for the prime rate, we're at 5.25% for the discount rate. We're going to go to 8.5%. That means that look at your borrowing costs on your auto loan or your credit card. The next time you walk into the dealership or you want to go get a credit card, you're going to see a higher interest rate usually on those things.
Yeah, by a little bit, not huge jumps, right? Generally, but like average mortgage rate if prime rate's 8.25, what is our average mortgage rate today?
Our average mortgage rate is in the high sixes, we'll say. So to be compliant, I will say the high sixes.
High sixes, and that's not, you're talking about a 30-year fixed.
Yes, 30-year fixed, and 15-year fixed rate money is low sixes.
Yep.
The reason why I don't say anything more specific than that is because there are a lot of factors that contribute to that rate.
Yeah, and it changes every day.
It does. It can change during the day, too.
It can change during the day, yeah. And so understanding that when we're talking here today, we're talking about today, right now, this minute in time, and understand that if you're watching this video in 6 months, rates might be different,
Absolutely.
You really need to check with your lender and see where their rates are at that moment. And when it comes time for you to purchase a home or anything like that, locking in your rate is always a good thing because then you know where it's at.
I was having conversations with 2 clients about that today. Yeah. One client was buying a duplex and the other one was buying their new primary residence that they had to write an offer substantially over the asking price to win the bid against 8 other home buyers.
Oof. Not a fun place to be.
Yeah, and the decision basically is that, like tomorrow, for example, on June 21st, the Federal Reserve is having a meeting on Capitol Hill where they're going to continue discussing their testimony on what the future data points should be for when they can actually pivot or what the state of things really will be. And all I can tell you is that fish in the hand. What is that saying? You'd rather
2 birds in the hand or something. Is it fish in the hand or 2? I don't know what it is.
You want to you'd rather know what you're going to get right now than worry about what you might not get if you wait.
Yeah, unless you're a real gambling sort and hey, roll the dice. But I don't know.
A bird in the hand is better than 2 in the bush.
I think that's what it is. Something like that. Yeah, sounds about right to me. But either way, what you're doing, you want to know your future, and that's kind of what we're getting at.
We always encourage people that locking at the time they get an accepted offer is the best practice.
Yeah, gambling and wait until see what happens.
This client, it was going to be a $26 swing in their monthly payment if the rate went up 1/8%.
Okay. Yeah, I mean, but if it went down. But who knows? You just don't know.
Got to see what your appetite for risk is.
Maybe it goes up a little more than 8%, and then it goes. Then you're looking at a $50 difference, So it's really, when locking in at a rate, know what you're at, and then you know what you can work with moving forward through the transaction.
Absolutely.
But when it comes to interest rates, understand that they do change. They can fluctuate. Prime rate, discount rate, whatever that may be, check with your lender, okay? We don't expect you to know what those rates are on a day-to-day or minute-to-minute basis. Your lender, as long as you have somebody that you can contact and work with, a local lender, okay, like Bank 59, they'll be there to help you out, and Bill will pick up the phone, answer your question. Oh, yeah, this is what it is right now. Do you want me to lock you in? Yeah, boo, here we're done, But if, there's some fluctuation in your transaction or whatever it may be, or maybe your pre-qualification letter ran out of time or whatever, you need to get a new one.
Having a second opinion.
Yeah, having that person local here just has so much value, and that's where Bill Moeller at Bank 59 can really come on to help you out with that. So let's get into our first one, HELOCs. What is a HELOC?
So a HELOC is, that's an acronym, right? It's home equity line of credit. Mm-hmm. And a home equity line of credit, if we look at just the overall scheme of your equity position on your property, most people associate a home equity loan as a second lien that's behind the loan that you got when you bought your house.
Yep. So you took out a $250,000 loan, you have $150,000 in equity, and you're going to take out a $50,000 lien against that equity. And
years ago, back in the early 2000s to mid 2000s, we were doing 80-20 mortgages where people would get an 80% first mortgage and a 20% second mortgage
to get away from
PMI
insurance.
And then we were doing 80-15-5 or 80-10-10. But now the cost of mortgage insurance has actually gone down. And you'd be surprised how many people whose parents told them that they needed 20% down to buy a house. Wow. Or in this case, if you think about the tangent, not using your home equity because it was really just frowned upon in certain mindsets. Yeah. When in reality, your house appreciates completely independent of how much of your equity you've temporarily used for what the purpose is, so long as that you can justify what you're using it for. So home equity line of credit, that's can also just be a loan as well. Not like, think of a line of credit like a credit card. Of course, you can, basically use it, and the monthly payment will be based on how much of it you used.
Yep.
And the majority of places only require you to make the minimum interest only payment for what you've drawn.
Yeah.
So if I draw $10,000 on my home equity line of credit, and let's say that the interest rate is 6% interest, just as an example. So let's say it's $600, and $600 divided by 12 is $50 a month. That's all your interest is.
Yeah. Yeah, and a home equity line of credit, it's available to you. Like, you can take out, let's say you had a $100,000 home equity line of credit. You can use it, or you cannot use it. You can have it at zero usage, and then you would have zero interest charge, so you wouldn't pay anything to have that $100,000 available to you in the event that you needed it. And some cases, some people just carry the home line of credit as just, hey, it's there.
I have one for a safety net.
Yeah, it's there if I need it. But they do run out eventually, right? They have a
10-year drop period,
time limit period. Yeah, and then as far as your interest rate on home equity line of credits, generally they fluctuate with the prime rate.
They fluctuate with the prime rate, and they also fluctuate based on your credit score and based on your equity position in your house. So, for example, there are some places right now in the area that will give you a home equity line of credit up to 95% loan to value. And when we were in a more stable market, there were actually places that were doing up to 100% loan to value. So that means you basically think of it like a glass of water. The glass is totally full. That represents your equity. You're asking to go to the lender and consume all of your equity. And if you're going to do that, they have what they like to call risk-based pricing.
Yeah. Well, and that gets a little tricky.
It basically means that we're going to charge you a higher interest rate the more risk that you're causing us to take.
Yeah, and because you're eating up all that equity, there's no room in there if something goes wrong.
And this whole idea that because you're consuming that equity, they still have a security interest in your property. So if you don't pay them back, yes, they can foreclose on a second mortgage just like they can on a first mortgage. Yeah. It's a little bit messier, though, because you're in second position on title. You're not in first position.
Yeah, the bank would have as much control.
Right, exactly.
Yeah.
Yep.
Yeah, and with HELOCs, they can be a great resource for you.
Absolutely.
Of having that available to you if you want to be investing in things or anything like that, or if your kid's going to college and you need to write a $5,000 check. Well,
yeah, we should do a deeper dive on that. The other thing that I'll tell you, like a recent story, was a client in Washington County purchased or set up plans to build a in-ground swimming pool with the landscape around the house and the whole 9 yards. And they got a home equity line of credit or a home equity loan for $130,000. Okay. And they looked at the fact that they're going to be able to restructure that debt down the line. It was taking a year to get to get an appointment to get your pool put in.
Holy cow.
By the time they actually got on the list, could get the appointment, they basically are going to say, okay, we're going to prepay this because there is no prepayment penalty on home equity loans. Yeah. So you can pay double payments. You reduce your interest by a considerable margin if you prepay it.
Mm-hmm. Yeah. And the home equity line of credit versus home equity loan, the biggest difference is the loan is going to have a fixed rate. The line of credit is going to have an adjustable rate.
Yes. And for those that realize, like this particular client, $130,000, if you knew the interest rate was going to go up 0.5%, you would appreciate the reality that you knew that payment wasn't going to bump up on you.
Yeah. And knowing your future has value. You know? And so knowing what that interest rate's going to be when, a year, 2, 3, 4, whatever down the road, you know what that interest rate's going to be and what that payment might look like. So you can kind of regulate your life a little bit.
Yeah, I've got another really popular angle that a lot of people are using these home equity loans or lines of credit for, and that is to become an accidental landlord.
Oh.
So you've accumulated so much equity in your house because your house appreciated in the last 3 to 5 years a considerable amount. Yeah. Did you know you can go purchase a single family house or a condo in another market? You can do an Airbnb. We didn't talk about this, by the way. We didn't. You can do an Airbnb.
He's throwing me a sidewinder.
Actually use market rents for what the market rents are in that community. Yeah. And you can actually use that mortgage payment or the rents to offset that mortgage payment for the place you bought. Use your equity to go buy another property where that tenant or if you're going to do short-term rental, where you're going to have someone coming in, which they've found that they're making more money on Airbnb in a lot of communities. Those people are using that equity as an investment vehicle to spread it out a little bit. Oh, okay. And they're making even more money or building more equity, because we always say to people, if you are if you're not owning a house, you're making someone else's mortgage payment.
Essentially. Yeah.
Yeah. So the accidental landlord strategy is also a really popular one.
Yeah. Well, and with the Airbnb stuff, that stuff is really taken over a lot of the marketplace as far as rentals and that kind of stuff. So that is changing. I mean, you hear people that a guy is renting a condo from a guy down in Florida, and he's not even living there. He's just Airbnb-ing it out every month, and he's making money because the rent on the condo is only $1,000, but he's bringing in $3,000 in Airbnb money on that same condo.
And the reality is, those short-term tenants take way better care of your property than a long-term tenant does.
Yeah, for sure.
Yeah, so that's another good thing. But as we talk about the different angles of what you can do with your home equity, there are when the stock market, when it was a bull market and it was running, I know people that were. And I'm not making investment advice here.
Yeah.
There are people that are using their home equity to invest for a higher rate of return. There are people who are using their home equity, of course, to make sure their kids' student loans were paid off, or that they could fund their kids getting married or something.
Yeah.
You could, of course, I personally believe the best way to use the home equity is to make home improvements, because after all, those home improvements hopefully increase the value.
Yeah, definitely a return on investment. As far as that goes. Yeah. And basically when you use that home equity line of credit or whatever, whether it's or cash or refi, now you're increasing the value of your property, increasing the equity. So it could be a and customers will come in with a plan and they'll say, well, we want to get a renovation loan. That's where the conversation will start. And then they'll say, but I have my Uncle Ted that'll do the plumbing. And I actually know a guy down the road that'll do the electrical. And then all of a sudden I'll go, are they licensed contractors? And then they'll say, and you can relate to this. Yeah. The weekend handyman wants to get involved in the project. At that point, we can't do a renovation loan anymore because we don't have bids from licensed contractors. Yeah. So now you're either going to do a home equity line of credit or you're going to do a renovation loan. Yeah. And when you do renovation loans, the draws have to be made by licensed contractors. Absolutely. Can't just be Uncle Buck down the street who shows up in his overalls. Yeah. Yeah, for sure. Now, HELOC is one medium that you can use to draw that money out of your equity, okay, to get some of that equity money out to do other things, okay, and have available to you, and it has its benefits. But there is another option that is very frequently used, and that's a cash out refi. Yes. Now, cash out refi basically is refinancing your home and taking a certain amount of that equity out of it. So, if you own a home for, let's say, $300,000 is what the home's value is, and you have $150,000 in equity, you don't have to take another $300,000 loan. You could, you don't have to refi at $300,000. You could refi at $250,000 if you wanted to, right? Mm-hmm. And then you would get $100,000 out of that refi. As you decide how much, and you're going to basically put all the eggs in that one basket. Yep. And the advantage to doing that, of course, really depends on what everyone will say, because basically about 80% of the people who have a mortgage in the United States is starting with a 4 or less. Okay. So people will say to us that they go, oh, I will never refinance my first mortgage because I have an interest rate at 3.5% interest and I'm never going to get that rate again. Mm-hmm. So that's where we're going to get into this discussion in a few minutes, where we're going to talk about blended rate calculators. And we're going to talk about the notion that if you didn't do the math, you don't know what you don't know. Yeah. So I'll give you an example. If you were in a situation where you owned a house that was, let's say, worth $300,000, and you had a first mortgage on your house that was at $150,000, 3.5% interest rate, but you had $80,000 worth of credit card debt and it was at 20% interest. Yeah. That person probably has a blended interest rate that's in the low 7s. In their mind, they think they have this really low cost of money in this bigger bucket. But the reality is the interest rate on the smaller bucket is at such a high rate that they're not really going to ever get out from under that. And they're not going to really be able to really make progress paying it down. That's why those people have to give a really hard look how long they're going to stay in the property, and the idea that they put those two loans together. Mm-hmm. And at Bank 5.9, we do up to 90% loan to value cash out refinances, when a lot of the places only go to 80%. Fannie Mae guidelines, they say 80% loan to value. Yeah. If you were doing it on a investment property or a second home, they have just actually substantially raised the surcharges on interest rates
for cash out refinances. And here at Bank 5-9, we have an option that does not have those same surcharges. So I encourage anyone that's looking into cash out refis on their first mortgage to give us a look.
Yeah, and that way, what you do with a cash out refi is you get that lump of money at closing.
You do. So 3 days after closing, because you get a cooling off period.
Sure.
Yeah.
Cooling off period. And that money just gets deposited into your account. It's available to you to
right
use,
away.
And you have to manage that money how you want. With a HELOC, the bank kind of stores that management for you.
Well, you just didn't draw on it yet.
Yeah.
Or with the amount you drew, you're going to pay a proportional payment to what you drew.
Yeah. Yep. So it's just another option. And as far as the HELOC or the cash out refi is going to be however you want to refinance your loan. All of the lending products that are available to you when you're taking out your mortgage are available to you in a cash out refi.
Yeah, we in fact, you have to get into these conversations frequently with people because for those that are veterans, and we want to serve those veterans right. There are specific guidelines to VA cash out refinances. There are specific guidelines to FHA and also on conventional. You see, if you have a lower credit score, the one reality of us hearing that R word, recession, and it keeps being brought up frequently, when you have an inverted yield curve where the yield on the 2-year treasury is higher than the 10-year treasury yield. That's when we have what we call an inverted yield curve. The greater that curve separates, the more likely that we are to be in a recession. When that happens, we experience what we call credit tightening, which is why when we have a situation like this where they are actually surcharging interest rates higher for those that have lower credit scores.
And they're just tightening the seatbelt, preparing for a potential roller coaster.
And it seems like it's a little bit of a slow burn, and we're really trying to actually... it takes a lot of focus for me to not go off on too far of a tangent here. Yeah. You don't have high unemployment. A lot of the economic data
factors aren't there right now.
Yes, they're not.
Yeah. Yep. But this inverted yield curve is there, and that is one of the key factors to signaling a potential.
Historically, it has been. It also historically says that when the true effect of that has happened the last 3 times, we actually did have another interest rate rally.
Yeah. And the Fed and the Federal Reserve Bank, like we were talking before, they're trying to manage all of this so that doesn't occur.
Correct.
Right. And it is it's
soft landing versus, are you going to have a V-shaped recovery, a U-shaped recovery? Are you going to have a soft landing? That's kind of what they're trying to figure out what they're going to have.
Yeah, and that's where they manage the interest rate and stuff like that to manage that landing per se. But ultimately, as far as those types of things go, you can't predict the future. Nobody can. There's as many talking heads as you want to listen to out there. They've been talking recession and housing crash and all that for years now.
Yeah.
And
yes, they have.
Still hasn't happened. It may not happen the way they're anticipating it. It's impossible to predict at this point. However, your life is now. Your life is reality, and if the reality of your life right now is carrying $30,000 in credit card debt or carrying student loans that you're not prepared to start repaying or anything like that, a cash out refi may be a great option.
You brought up a really good point. The Debt Reduction Act that just got passed. They are going to start making people start paying on their student loans again in August for the first time after 3 years. Tammy, can you go to the PowerPoint slide that we got pulled up on the screen? So this PowerPoint slide that I'm showing you here, this is going to be the credit card debt in the United States as of January of 2023. Consumer credit card debt is $943 billion, and the average car payment that someone's taking out right now for a new car is $725. The average used car payment is $536. And look at that interest rate for a used car. You actually can't get a used car interest rate on the average nationwide for like a car that's 2016 or older. That's below 10% interest.
Yikes.
So when we look at these things, we just want everyone to be mindful of the idea that using home equity effectively can stave off the impact that this interest has on your affordability for your monthly cash flow. The other thing that I was going to show you is if we were in a situation where we said we were going to look at the impact of a blended interest rate. So we're going to go to this one here where I'm going to show you what I said earlier. I talked about if you had a situation where you had $150,000 first mortgage at a 3.5% interest rate, you had a $50,000, let's say, credit card balance,
Sure.
and that was at 20% interest. And let's say that maybe is just like you have 3 or 4 cards, Matt.
Yep.
But those cards, you've been chipping away at them. You're paying $1,000 a month here. You're really diligent about paying them. They tell us that if your utilization ratio is over 30% of your limit, that your credit score is going to drop.
Definitely, yeah.
And so that's what another check mark in the consider using the equity column, because the reality is now that you can't really bounce from the promotional teaser rates the way you used to.
Yeah.
Look at that interest rate. 7.625% is the weighted interest for if you had that higher. So you thought you had a 3.5% interest rate.
Yeah.
But because you had just 50,000, that was the reality of that situation. And I take a similar example, but Bill, I have a 3% interest rate on 200 grand.
Yeah.
Well, I have 80,000. Let's just say it's at 18%. You're in a similar situation.
Mm-hmm.
So what I'll show people is, and we'll talk about this in a little bit, we use a mortgage planning spreadsheet where we basically say if you took the sum of the payments that you're having to make on all these cards,
Yeah.
you could literally put someone in a 15 or 20-year fixed rate mortgage and be running with the same payment.
5% or 5, whatever.
Well, it could be around low sixes.
Low sixes.
But when you run those numbers, it's kind of something that people don't even think to experiment with.
Yeah. And that decreases the overall percentage you're paying on that money.
Yeah, because when you look at an amortization schedule on a 30-year loan, it takes you to level off, it takes you somewhere between 13 and 15 years for the proportion of the amount you're paying to interest and principal to level out.
Yeah, so don't think about your 3%. Think about your blended rate being, and this he's just using one credit card balance as the thing. You could put your credit card, you could put your car in there, you could put whatever you have loans on or lending products out on. You can put all those in there to see what your blended rate is, and then you want to try to pick and move these things around into different categories to reduce that overall blended rate and reduce the interest that you're paying on this money that you have out there in the lending world.
And Tammy, one more time, if you don't mind, let's talk about the blended rate calculators that you, the consumer, can use on your own while you're not on the podcast with Matt and I here. I highly encourage you to spend a few minutes and just take some of your balances, provided that there are apples to apples on the length of the term. Just search blended rate calculator. Go ahead and put your balances in and your rates and look at what your blended rate is on your debt, and that'll help you gauge whether or not you should get an opinion from someone like me to evaluate it.
Yeah, and if your blended rate's coming in at 4%, well, then there's probably nothing to do with it.
Then you're good.
Yeah, then don't worry about it. You know, but if your blended rate is at 10, well, you have a lot of money you could save by taking some action. You know, and that's where we're talking to Bill about your different options and stuff, and he has more tools than what he's just showing you here, you guys, and he's just a great wealth of knowledge to help you decrease the amount of money that you're paying in interest rates and things like that, and make your life a little bit easier. Okay, make it a little bit easier to exist in this great difficult world which we call the U.S. financial markets. So it is something. But when we talk about these HELOCs and cash out refis and interest rates and all this stuff, if it's over your head, if you're like, these guys are just talking a bunch of gobbledygook on the YouTube here,
Charlie Brown school teacher,
come and sit down in the office with Bill, and he has a great way to break it down for you into simpler terms or whatever, so that you can make sure that you understand exactly what you're looking at and can make some of the best decisions for you and your family. Okay. Now, the next thing we want to talk about is understanding a little bit about how these products are paid off. Okay, so a HELOC, we talked about, is you're paying a minimum payment based on the interest of the amount that you have been using.
Interest drawn.
Yep. And then when you're talking about a cash out refi, you're just paying it like your regular mortgage. So there's two different ways of paying
so
that
think
back.
of it like we got in the Uber and the meter started running.
Yep.
And so basically, from a cost of funds standpoint, similar to a credit card, you're going to make a minimum payment based on the interest that accrued per day. Mm-hmm. So what we would do is we would take the loan amount times the percentage of interest and divide it by 12 to get the monthly amount.
Yep.
That's that example I gave you earlier, if I had $10,000 and it was 6% interest, type of thing. And then whereas with a 30-year amortization, or if I did 15 or 20 year, we're going to be in a situation there where we're going to we're going to put all those numbers side by side on a spreadsheet again, and we're going to evaluate it, because there's another, as there is with everything, there can be a trap for a lot of different factors. And that one thing I always tell people is, don't get a home equity line of credit if you're in your subconscious mind, you say you're going to make, I'm going to pay extra every month.
Yeah.
I promise, Mr. Loan Officer. And then in reality, all you do is make a minimum payment.
Make the minimum payment they require of you.
Because then the drop period ends after 10 years.
And you're stuck with having to pay that back.
And now your equity is tied up. Whatever you put on there is tied up. So you have to really be conscious about what you're going to do with it.
Yeah. And after that 10-year period, let's say you have $80,000 still on the HELOC. What happens to it?
Depends on the lender. For a lot of lenders, they're going to switch you to a principal and interest payment because they don't want you to keep kicking the can down the road.
Yeah, basically an amortization schedule. Yeah, so that eventually draws automatically.
Otherwise, you got to refinance it.
Yeah, yeah. And then as far as the cash out refis, that's just your regular mortgage payment. It would just change because whatever your mortgage payment was on a different loan product, obviously, and at a different interest rate. And it may have been that you had a $300,000 loan and now it's only a $250,000 loan. So maybe your mortgage payment goes down, but it's at a longer term, but it all is relative to what you choose. So if you choose to go into a 10-year repayment plan versus a 15 or whatever, obviously that's going to affect the interest rates and things like that. Yeah.
And we have situations too where people get closer to retirement, but they're in this tough spot because they really worked hard to knuckle down and get their debt paid off. And then they all of a sudden fall into a situation where they have some medical expenses, or they accrued some credit card debt, or they had car repairs, or whatever the case may be.
Shit happens, right?
They go and get a 10-year fixed rate mortgage from us. We'll portfolio it. We'll give you a nice low fixed rate, and we can help people get into a situation where they can free up some of that capital out of the equity to do what they need with it.
And it's a tax write-off then at this point.
Absolutely.
If they don't change that.
Depending on, a lot of things that factor into the standardized deductions and stuff like that. Talk to your CPA.
Yep.
There's a chance that it could be a tax benefit too.
Could be. Yeah, for sure. But that is HELOCs and cash out refis. I think we covered that pretty thoroughly.
Yeah, I'd say we should.
Gives you a good idea.
We should. Do you think maybe we could show that mortgage coach spreadsheet?
Oh,
quick?
Yeah. Well, we didn't get into that, did we? Skipped over that.
Yeah.
So the Mortgage Coach spreadsheet is a tool that Bill has that he can go through with you. You just have to get a hold of him. But this is kind of how it goes. Give him the down low, man.
Yeah. So total cost analysis is a tool that I've been using for over 10 years. And a great guy by the name of Dave Savage in California, who is a pioneer in the mortgage industry, came out with this program where, as a mortgage lender, we are basically debt managers. And, you can get a lot more sophisticated in the way that you approach your debt if you have someone that's going to be a debt manager versus someone that's just going to quote interest rates.
Yeah.
So our objective is plain and simple in a situation where if you're buying a house, we have to help you map out first of all, we're going to help you figure out what price point you should be looking at by showing you a range.
Yeah.
And then if you are in a situation like this particular client was, they closed on a house last December and their interest rate was 6.5%. And I gave them a very low closing cost option to get into a 15-year fixed, and I showed them how much they were going to save in interest.
Yeah.
So this type of tool, because we're licensed through the majority of the nation, we help people evaluate with these kind of tools. And the thing that your elder parent or your someone who basically doesn't really do the due diligence says is that you always need to save 1% on your interest rate. Have you ever heard that?
I've heard that. Yep.
Yeah, you got to save
right
1% on the rate.
Pay 20% down. That was old wives' tale stuff. But
yep.
Yeah.
So in this particular instance, this customer took a loan that was for $175,000. And they wanted to pay it on a 15 because I always ask people, how long are you going to stay in your house and when do you want to retire? And I also help them look at their debt to income ratio. Well, this particular customer had a $335 increase, but in 5 years' time, they saved $10,000. And in 7 years' time, they also looked at how much their total sum of their payments was going to be and how much they were going to save. So we're using tools that we can forecast out for people the idea of how much equity you're going to have in the property.
And see the dollars and cents.
And actually see it, because if you don't use a tool like this to help someone evaluate their financial plan, honestly, the customer is left on a little bit in the dark. And you can even see in here, we even have a tab for closing costs we do a screen share, we do a Google video meeting, or we'll meet with you live and go over it.
Yeah, that's great. And we will, in the replay, we'll flag Bill's information in here, but we also have Bill's information up on our website, thehelpfulhomelesspetcher.com. You can go out there and get his contact information, email, phone number, all that kind of jazz or whatever. Another great resource. But you need somebody to lead you through that process. Just plugging in numbers in the balance sheet that we looked at before is simple enough to do on your own, but this is more than that. This is something where you need somebody to help you interpret those numbers.
Absolutely. It was, I always like to say it was your best thinking that got you to this point. Yeah. Just like no different than I go talk to my financial planner. If I have a technical question about my house, I talk to you.
Yeah.
You know, everybody thinks that advice from Google is great, but in reality, it's not great if you don't really know how to interpret it properly.
And Bill, how much does it cost to talk to you about mortgages?
It's pro bono work.
Pro bono.
Yeah.
All right. So Bill works for. He doesn't work for free. He gets paid.
I'm compensated if I go to a closing.
Yeah, if he makes it to a closing, that's where he gets compensated. But ultimately, Bill would be happy to talk to you. You don't have to make any payments or anything like that. But I would almost guarantee you that you're going to learn something from him when you sit down to talk to him. And with all likelihood, he's going to be able to find some ways to save you some cash. All right. So actually, we should have you save a buck. We should just have Bill Moeller.
Yeah.
There we go. Just next week. Tammy, we'll put that in. The next thing that we have is our question giveaway of the week. And the question giveaway, we are giving away this so stylish.
Ooh, that's fancy.
Titleist golf hat that we're giving away. And the winner of the hat is going to be the first person to put in who is the chair of the Federal Reserve. This Federal Reserve, we talked about it earlier. Who is the chair? It was briefly mentioned. I didn't catch them in time, but
it was early enough.
It was early enough. It was long enough. They forgot all about that, And if they try to rewind, that means they're going to be rewatching the show like 3 times, probably. Yeah. So that's all right too. If you can put in the comments down below, and remember the rule is if you've won it within the last month, you cannot win until month is up. Put the name of the person who is the chair of the Federal Reserve in the comments below, or if you're watching the replay, you can put it in the comments, and the first person to put it in, we will award you this nice, fancy Titleist golf hat. And then as far as the mystery box battle, we're kind of running a little short on time because I really wanted to get to the 5 things that we can give people tips on improving their credit score.
I would like to do that. We could go into extra innings for just a couple minutes and cover those things.
We could, if that's cool with you. Yeah. So the what we're going to get into next is going to be the top 5 things you can do to improve your credit score today. There's a number of suggestions I've gathered over the years. I'm sure Bill has even more than that. We have a plethora, and we're going to do a little tag team, if you don't mind.
Let's do it.
Yeah. All right.
Ready.
So what would be your first one, Bill? What would be the biggest thing that you would give somebody a suggestion to improve their credit score?
Make a list of all your credit cards, use a application like mint.com, for example, and find out what your limits are by getting a free copy of your credit report and pay down those balances to below 30% of your available credit limits. That's my number one.
There you go. Number one. Mine is going to be don't eliminate your credit. So people think, I'm going to pay off my credit card or whatever and
close
get rid
it.
of it. Yeah, don't close it. Keep it open.
Yes, keep it open
as long as they'll let you. And if sometimes credit cards, you do need to use them once a year or something.
Otherwise,
like that.
they go stale.
Yeah, otherwise they go stale. And the whole thing with credit scores is they do it based on your available credit. So if they see that you have $15,000 available on your Cabela's card, and on this Visa card you have another 10, you have another 25, all that adds up into a great big ball of available credit.
Yep.
And they want to see that you have a big ball.
Yep.
If all you have is a little tiny ball, that looks like you look like a college.
You should
kid
have at
that
least
just got
3.
done.
You should have at least 3 credit cards.
Yep.
And even just set them up. So like I'll put a subscription on one of my cards that I use for travel expenses, and I just set it up to be paid in full every month. And it's only like, let's say there's only like $30 to $50 being put on it, but it's just automatically getting paid every month.
Yep.
That contributes to my FICO calculation.
Yeah. And I think it's just important to make sure that you keep maintaining that size of your credit. Because lots of times when we close accounts, we pay off things. We feel good about that.
Liberated.
Yeah, we feel liberated that we don't have that weight hanging over us anymore. However, it eliminates a little piece of that ball that you had. And and when it comes to credit scores, the TransUnions of the world, the Equifaxes, they're looking at that as you have a smaller ball. So
yeah, absolutely.
What would be the next one?
The next one I would say is if you get a medical collection, make sure that you evaluate your rights regarding how you're going to pay it off and make sure that you handle it properly, because you can actually hurt your credit rating by paying it in full because you're making an admission that you owed the debt. You can usually call the medical collection agency and you can ask them to delete it in exchange for a full payment. If you just ask them real nice, chances are they'll delete it in exchange for a full payment instead of marking it as paid on the credit report, which actually says, I did owe you that money, and now my FICO score will be damaged as a result of me admitting that that collection was legitimate.
Yeah.
You can actually get it deleted. That's a really big thing that we'll do. There's a few collection agencies in Wisconsin that we can get collections wiped off a credit report in 2 weeks, bump people's credit up, and then we make clients for life doing that.
Yeah. And the reality of it is these credit collection agencies, they want to work with you. They're happy when you're willing to sit on the phone with them, because they spend all day talking to people that just keep hanging up on them, trying to avoid them.
And it's really surprising when you think about it that some of the collection agencies really have a stereotype, but in reality, they get paid two ways. They either bought a bulk sum of bad debt and they're trying to collect on that bad debt that they bought from someone else for pennies on the dollar, or they're on a contract with a medical company and they're getting paid regardless of whether someone pays that collection off. So they're just trying to collect on it the best they can.
Or they get a bonus if they get a collect or whatever. So that is a good one. The next one that I'm going to give is, I would say, always make your payments on time. One late payment can dramatically affect your credit score, and making sure you make those payments on time or ahead of time are always a good thing. Setting up automatic payments is a great idea, because that means you're not going to accidentally miss it because you're on vacation or whatever, but one negative mark like that can dramatically affect your credit score for anywhere from a year to 2 years in some cases. You could have one negative spot 3 years ago or whatever, and it finally just falls off and doesn't affect it anymore. But
I work with a lot of people who once they think about establishing like triggers or alarm or put it on your calendar, just go into the websites and set up a recurring minimum monthly payment to come out, so that if you don't make the payment, at least it takes the minimum payment.
Yep.
Because then that way you're in a better spot.
Yeah, for sure. Got another one?
Yeah. The other one would be for those of you out there that don't feel like you have established credit. The other one would be to get added as an authorized user on either your spouse's or your parents' credit card that they only use occasionally. Not one that's going to be maxed out, because we went back to that first example I gave. Yeah. But let's say I'm coming to you and you're going to help me get some financing, and you pull my credit and I don't show a FICO score. Yeah. And it's because usually what happens for those of you out there who have kids that are just starting in college, you either get your kids a secure credit card where you put some money up to get a credit card that gives them a pulse on the credit report, or you add them as an authorized user. And like with your sons, all you have to do is have them, is you call and you basically say you want to add them as an authorized user, and then that card and the history of that card will appear in their FICO score calculation.
Yeah. That's a good one, and that way it branches them into that without them having to bear the full brunt of having that weight on their shoulders.
Trying to start climbing the mountain all on your own.
Yeah, for sure. So
would a gas credit card count for that purpose?
If you have a gas credit card, like you have a quick trip card,
yes, it does.
BP, okay. You can still use that credit card anywhere. It's a regular credit card.
Bank 59 does offer secured credit cards, and for those of you out there who are in situations where you can't get a credit card, if you come in with $300, we have a credit builder program. Okay. So we'll go ahead and we'll put people in a credit card that will report to the credit bureau, and that will use their money as the skin in the game for the credit card.
That's what the $300 is.
Yeah.
Oh, sure. Yeah. And that way you Bank 59 doesn't take a lot of risk then.
Right.
And that works out, because then they get the benefit of having that credit being reported. Yep. To the credit agency. Yeah. And I know that's 5, but I'm going to give you a 6th one. Know your credit score. It doesn't cost you nothing. You can get a free credit score printout from, I think, all 3 of the.
I actually made a YouTube video about this on my channel.
Did you?
Subscribe.
What's your channel?
Bill the Banker. I will. I'll have Tammy add it to the comments
description. Yeah.
I have a YouTube video that I made that was 3 to 4 minutes long that talks about the disparity among credit scores between Credit Karma and the other credit reporting agencies.
Yeah.
But basically, there's so much out there that, first of all, if you go to annualcreditreport.com, you don't even get a credit score for free. And if you do pay for it, it's usually 30 to 50 points off of the ones that the mortgage companies use.
Yeah.
That's just one example that I'll give you. But if you watch the video that we'll add the link for later,
Yeah.
just like and subscribe.
There you go. When Bill briefly mentioned Credit Karma is one way that you can go in there, and it gives you a roundabout score, but it doesn't give you a very accurate score.
Correct.
It's in the ballpark. Okay, and it's better than nothing, and it is free, and you can check it regularly. They do have your credit card balances and things on there, and stuff. It is a great financial tool. But it is not something that you should rely on. You really want to know what your true credit score is, and if there are improper things that are put on your credit score and things like that, you can submit to get those deleted or removed.
You can still do it through there.
But if you don't know that they exist, if you're not looking at your credit score, you're never going to know those.
And also what you should or shouldn't dispute. Yeah. And also what happens when you dispute something, how something can come back to haunt you later if you shouldn't have disputed it in the first place. There's a lot of pitfalls with that if you don't do the research properly.
Yeah. So those are some good suggestions to help you manage your credit score. Getting that credit score up as high as you can is always going to benefit you financially, whether it be looking for a loan, a credit card, whatever it may be, even insurance, which is we're going to have Dan in from Colonial Insurance. We're going to talk to him a little bit about that. But car insurance these days is based on your credit score. It sure which is kind of crazy, but it is I forget who it was that it's a measure of risk,
Sure is. Well, there's a lot of ingredients to that recipe that kind of cross over into a lot of areas as to how insurance performs, how loans perform, etc.
Yeah. So good information there. Now, as far as wrapping up the show here, we do have our tip of the week, and I'm going to tell you guys right now is the time to paint and prep your exterior wood trim. Okay, if you have wood trim on the outside of your house, you need to protect it. If you don't protect it, it's going to deteriorate, it's going to rot. If you have woodpecker holes, fix them. But now is the time when it's nice and dry out there, when the weather is warm, and when we are not having as much rain and not as much moisture in the atmosphere. That paint's going to stick and hold better and adhere to the wood material better. Usually you want to try to do it in a little bit of shade. You don't want it to dry real fast. Okay, but when you're fixing that wood, if you have a rotted piece of wood, take the board off, repair anything that may be behind it. But before you put that new board up, paint and prep all 6 sides of the board before you put it back up, because once you put it up, you can't paint the back of the board, and you want to make sure to encapsulate that board so you don't have those types of issues. Now, as far as the wood goes, you always want to make sure to strip any loose paint off. You want to make sure to put down a good coat of primer after you've sanded and stuff, and then you want to put your good quality paint on there for at least 1 or 2 coats. Okay, and make sure you're using an exterior paint, not an interior paint. It'll just wash off the house.
Can't use latex?
You can use latex, but it needs to be exterior grade latex.
Yeah, okay.
So it ultimately, if you go and you're buying a high quality exterior paint, it'll say it right on there, exterior use only. Okay.
Makes sense.
Yeah, and try to avoid anything that says exterior or interior. That's not going to be the product that you're necessarily looking for. But now is the time to do that. All right. Now next week we've got Dick Vanderheiden coming in from the Germantown Fire Department, and he's going to be talking to us about fire safety. And basically, as a precursor to 4th of July, we're going to be talking about fireworks safety specifically.
I got all my fingers.
There you go. Yeah, I got one of my good buddies, Chad. Him and his brother went over to the big fireworks where they let him off at the park. Yeah. Picked one up, and Chad and his brother's like, "Hey, Chad, hold this. I'm going to light it. You chuck it." And the fuse was so short and ended up blowing off a part of his thumb, part of his finger, and the guy took
I did a mortgage for a guy that works for 5-Star Fireworks, and I've heard a lot of stories.
Oof, just terrible stories out there. But we're going to try to avoid this. Dick Vanderheiden is going to come in here and help us understand a little bit about fireworks safety and kind of making sure everybody doesn't get injured over the holiday period. And we're also going to talk about cooking safe, because a lot of people are going to be cooking out, right? We don't want to make sure we don't burn our houses or burn off our eyebrows or anything like that. He's also going to talk to us a little bit about campfire safety and fire pit safety and how we can manage small children and like that kind of stuff around. And then we're going to talk about the truth about gasoline. It's going to be a high-powered conversation.
I'm going to be tuning in.
Fire safety, yeah. So that is going to be next week. Don't miss it. 7 to 8 p.m. Tuesday next week. The Helpful Home Inspector Show live. Thanks, Bill, for coming in today, man. I appreciate you.
Cheers.
Yeah. If you guys are looking for mortgage products, HELOCs products, any type of advice dealing with your managing your equity in your home, Bill Moeller is the way to go. Give him a call. His information is up on our website, thehelpfulhomeinspector.com, and in the replay, Tammy will drop that up on the screen for us, right,
BillTheBanker.com.
BillTheBanker.com. Was that a website too?
It's legit, my website.
Oh,
Bill the Banker.
There you go. BillTheBanker.com. Go there and get a hold of him. But thanks for tuning in today, you guys. Hopefully you found this information useful, and we hope to see you next week. Remember, you guys, the better you take care of your house, the better it's going to take care of you. Have a good one.